When software starts behaving like this, I pay attention long before Wall Street agrees with me. I have lived through enough market cycles to know that fortunes are rarely made when everyone feels clever. They are made when a whole sector gets hit with a story so loud, so emotional, and so repeated that people stop asking whether the price decline still matches the business reality. That is where software has been living. Not in a world of collapsing demand, not in a world where customers disappeared, not in a world where the leaders suddenly forgot how to sell, serve, or expand. It has been living inside a fear trade. The fear trade is always seductive because it saves people from doing real work. It gives them a sentence they can repeat at dinner, on television, or in an investment committee meeting without ever opening an annual report. Software is in trouble because AI will replace software. Enterprise leaders are doomed because some new model will wipe out their moat. The old names are finished. The new era belongs to anyone with a flashy demo and a louder promise. That kind of story sounds intelligent right up until you ask the one question that matters in markets. Who is actually making the money? That is where the fog starts to lift, because when I look at the serious software businesses, I do not see a sector in terminal decline. I see entrenched customer relationships. I see vast installed bases. I see recurring revenue. I see backlogs. I see mission-critical systems that large businesses cannot simply rip out because somebody on social media says a model can do it cheaper. I see boards of directors that still need reporting systems, sales systems, database systems, workflow systems, security systems, claim systems, compliance systems, and customer systems. I see giant firms that are not being erased by artificial intelligence. I see giant firms absorbing artificial intelligence and turning it into another lever. That distinction is where money gets made. The market spent months pricing software as if the sector was about to be cannibalized from the outside. Prices kept falling. Commentators kept finding cleaner and more dramatic ways to say the same thing. Investors started confusing a valuation reset with a business collapse. That happens all the time. People see a stock go down for long enough and they assume the fundamentals must be following the price. But price is often just emotion with a ticker symbol. Then one day the tape changes. One strong move in a leader, one large green candle, one signal that tells you buyers were not gone. They were waiting. That matters more than most people understand. In major recoveries, the first move often looks almost too simple. No grand revelation, no miracle press release, no single headline that seems big enough to justify the jump. Just a shift in behavior. A shift in who is finally willing to act. A shift in what the market is prepared to believe. That is the moment I care about. Not because a one-day bounce proves anything by itself. It does not. But because violent upside moves from deeply depressed levels often tell you that fear had run ahead of fact. And once that happens, the next thing the market has to do is reprice. First, it reprices the emotional overshoot. Then it reprices the business reality. Then if the outlook has actually improved during the sell-off, it reprices the future at a level above where people previously thought it belonged. That is the setup I am watching in software. Now I want to give you the full operating system I use for moments like this, because most people will miss the move for one reason. They are waiting for the rebound to feel safe. By the time it feels safe, most of the easy money is already gone. So let me give you the mother line first. When an entire software sector gets sold on fear, but the leaders still have customers, cash flow, pricing power, backlog, and the ability to use the very technology people fear, the sell-off becomes an invitation. Not an invitation to gamble blindly. Not an invitation to buy every stock with a cloud label, an invitation to separate software that was merely expensive from software that was actually broken. That is where this story begins. I have always believed that markets move through 5 emotional stages. Whenever a powerful new technology arrives, first comes wonder, then comes exaggeration, then comes indiscriminate buying, then comes indiscriminate fear. Only after all that do you get the useful phase. When the real winners are priced attractively enough for serious investors to do real business. Most people only recognize the first 3 stages because they are exciting. The 4th stage is where patience gets paid. Software has been stuck in that 4th stage. The decline did not happen because enterprise software suddenly became optional. It happened because the market started telling itself a horror story. What if AI destroys the old leaders? What if margins collapse? What if software spending stalls? What if every existing product becomes a commodity? What if the giants spend too much on infrastructure? What if customers wait? What if the whole stack gets rebuilt without them? You can lose a lot of money when you start valuing strong businesses on a chain of what ifs. I call this mechanism 1, fear compression. Fear compression happens when a sector gets repriced not on current business conditions, but on a hypothetical future where everyone assumes the worst arrives before management can adapt. Multiples compress faster than cash flow changes, price targets come down, analysts sound prudent, investors tell themselves they are being disciplined, but what is really happening is that uncertainty is being capitalized at the harshest possible rate that creates opportunity only when the underlying companies still possess adaptation power. Adaptation power matters more than disruption headlines. A small software company with no balance sheet, no customer lock-in, and no product depth can be wiped out by a technological turn. That happens. But a large enterprise software company with decades of data relationships, deeply embedded workflows, procurement trust, compliance infrastructure, distribution channels, and massive cross-sell opportunities is not standing still while some outsider sharpens a demo. It is building, it is bundling, it is integrating, it is making itself more valuable inside the same account. That is why the simplistic version of the AI story misses the most important point. The incumbents are not passive victims. They are active landlords on very expensive digital real estate. People hear the word disruption and imagine the fortress doors swinging open. In practice, what usually happens is that the fortress installs better weapons and charges higher rent. That brings me to mechanism 2, the installed base advantage in investing. I prefer businesses where the customer relationship is so deeply embedded that change creates more friction than staying put. Software at scale often works like that. A company can hate its software bill and still renew. A chief information officer can complain about complexity and still choose expansion. Why? Because replacement risk is real, migration is expensive. Training is painful, integration is political, data movement is dangerous, operational downtime is career risk. Once you understand that, you stop asking whether software is abstractly vulnerable and start asking a more profitable question: which companies are sitting on installed bases that become more productive when AI is layered into them? That is a very different question. Oracle sits inside databases, infrastructure, mission, critical workloads, and now a growing web of data center commitments tied to the AI build-out. Salesforce sits inside customer relationships, sales workflows, service architecture, enterprise automation, and the operating memory of how companies actually go to market. Even a more controversial name like SoundHound, where the risk is far higher, is still trying to build itself into workflows that clients do not want to recreate from scratch once the utility is proven. The point is not that all three names carry the same quality. They do not. The point is that the market sold them all with one broad emotional brush. That is where investors get hurt. They turn sector fear into stock selection. They stop distinguishing between a fortress under temporary pressure and a speculator living on borrowed time. I have no interest in doing that. My job is to identify where the market's emotional overreaction collides with real business durability. Oracle is a good place to start because the market often reveals its hand through leaders first. When a stock can jump sharply without some spectacular new event, you should not dismiss it as random. Sometimes that is the cleanest signal you will get. It tells you buyers were already there mentally. They just needed the tape to stop punishing them for acting. Software had been under pressure so long that many investors started to think the decline itself was proof. But one real break in price behavior can expose how one-sided sentiment had become. Now, I do not buy a stock because it printed a big green candle. I buy because I can explain the economics underneath the fear. Oracle's case is straightforward if you resist the urge to be theatrical about debt. The company has been spending hard to build infrastructure that serves AI demand. The market sees the debt and becomes anxious. That anxiety is understandable. Debt always deserves respect, but debt without growth is one thing. Debt supporting durable demand is another. If the contract's backlog and long-duration revenue potential are expanding meaningfully faster than the obligations taken on to build capacity, then the debt story is not automatically a red flag. It may be the visible cost of being early to a large wave. That is mechanism 3. The backlog to debt gap. When investors panic over balance sheet expansion, I ask a simple question: is the earning power being constructed larger than the leverage being feared? In Oracle's case, that is the heart of the argument. The data center build-out is not charity, it is not vanity, it is not management deciding to cosplay as a capital-intensive empire for fun. It is a response to demand. The backlog growth tells you customers are already forming commitments. And backlog, if it is serious and durable, is not merely a number on a slide. It is evidence that the business is moving from narrative into contracted reality. This is where many investors make a very costly mistake. They stop at the debt headline and fail to track the shape of the future cash machine being built behind it. Markets do this all the time. They price visible pain instantly and deferred earnings reluctantly. That mismatch is one of the oldest sources of opportunity in investing. Could Oracle fail to execute? Of course. Could data center economics disappoint? Of course. Could sentiment wobble again? Certainly, but if you force me to choose between the proposition that Oracle will be displaced by AI and the proposition that Oracle will monetize AI through its current position, distribution, and infrastructure, I know which side of that wager I prefer. I prefer the side that already owns the pipes. The next mechanism is even more powerful because it combines business quality with shareholder math. Salesforce has been treated by the market as if solid execution somehow no longer counts. That usually tells me people are too intoxicated by an idea and not sober enough about a business. This company keeps showing evidence that its products matter, that enterprises are still relying on it, and that AI can strengthen rather than hollow out its value proposition. Yet the stock has been priced like a business whose relevance is sliding toward expiration. That disconnect is exactly the kind of thing I look for. The market loves smooth stories and hates transition periods. It especially hates transition periods where a company is clearly useful, clearly profitable, and clearly adapting. But the next chapter is not easy to express in a slogan. That is where Salesforce has been trapped. Investors know the company matters. They know the customer base is real. They know the revenue engine is substance. But because AI made the future feel uncertain, they mark the multiple down hard and ask questions later. That creates what I call mechanism 4. The repurchase flywheel, when a strong company with durable cash generation gets sold down to a valuation that no longer reflects its economics. Management has an opportunity to convert market pessimism into per-share advantage. Buybacks are not magic. They are often misused. But when a company repurchases heavily at a depressed valuation while its business remains fundamentally intact, it compresses the share count precisely when the market is most confused. If the outlook later stabilizes, shareholders own more of the same business. That is leverage without leverage. This matters enormously. If Salesforce is trading at a fraction of the multiple investors we're comfortable assigning before the fear cycle, while still proving demand, still building AI utility, and still shrinking the denominator through aggressive repurchases, then the rebound does not need heroic assumptions to work. It only needs the market to stop pretending the business is broken. People underestimate how powerful that can be. A stock does not always need a miracle. Sometimes it just needs investors to become less irrational. If a company earns well, buys back stock, and keeps deepening its position with customers, then merely returning to a more normal valuation can create returns that feel dramatic. That is why some of the biggest gains come not from stunning growth surprises, but from the ending of a fear discount. There is another point here that serious investors should not ignore. The replacement theory around Salesforce sounds neat in conversation, but real. World implementation operates on physical constraints. Everybody talks as though unlimited AI capacity is sitting around waiting to destroy every incumbent tomorrow morning. That is fantasy. The build-out itself is capital intensive, the model training is expensive, the deployment at enterprise scale takes time, the compliance layer takes time, the integration layer takes time, the procurement layer takes time. Time is an underrated moat. That is mechanism 5, the capacity bottleneck moat. When a disruptive technology requires enormous physical and computational infrastructure before it can even attempt to replace an incumbent at scale. The incumbent receives a gift: time to adapt, time to embed, time to improve, time to lock in, time to take the new capability and sell it back to the customer before the disruptor finishes laying cable. That is why I am skeptical whenever someone tells me a large enterprise software platform will be casually erased by a younger AI company in the next few quarters. I have watched markets for too long. Real replacement is slower, messier, and more political than the futurists ever admit. Boards do not tear out systems on a promise. Enterprises do not move their most sensitive workflows because a conference keynote felt revolutionary. Most businesses adopt by layering, not by exploding. That is good news for the leaders. It means the market may have granted them a punishment multiple while still leaving them years of monetization runway. Now I want to talk about SoundHound, because this is where discipline matters. When people hear a thesis like mine, they make a dangerous mistake. They assume every beaten down software stock is a bargain. That is nonsense. Some stocks are down because they are misunderstood. Some are down because they are weak. Some are down because they are speculative, and the market has suddenly remembered the difference between a business and a possibility. SoundHound sits much closer to the third category. I am not blind to the attraction. The technology narrative is exciting. The client traction matters. The expanded deployments matter. Institutional buying matters. Analyst optimism matters. If the company can establish a visible path to profitability, the stock can move brutally and quickly, because speculative names recover with a violence that mature companies rarely match. That is true. But the reason I discuss it after Oracle and Salesforce is simple. Sequence matters, quality first, speculation. Second, I call this mechanism 6, the speculation tax. The speculation tax is what investors pay when they confuse optionality with certainty. Young companies with promising technology can create extraordinary returns, but they demand a different temperament. They can fall 35% and still be behaving normally. They can lose money, raise money, miss timing, burn cash, and still remain part of a valid long-term theme that makes them unsuitable for anyone who needs predictability disguised as excitement. So when I look at a name like SoundHound, I do not put it in the same mental bucket as the stronger software franchises. I put it in a smaller bucket with tighter rules. The catalyst I need is clearer. The pathway to profitability must stop being poetic and start becoming visible. Revenue growth must accelerate, margins must improve, cost control must be believable. Client expansion must turn from promising to repeatable. The market can forgive a lot in speculative growth, but only until patience runs out. That is why a rebound story must be built in layers. First layer, the sector was oversold on fear. Second layer, the leaders with installed bases and cash generation are more likely to harness AI than be destroyed by it. Third layer, valuation compression created room for significant upside even before new highs are considered. Fourth layer, the more speculative names can participate, but only if the path to profitability sharpens enough to convert imagination into finance. That is how you avoid turning a good sector call into a bad stock call. There's another lesson here that many investors never learn because they are always hunting novelty. When a sector rebounds after an emotional sell-off, the best opportunities are not always the sexiest stories. Often they are the businesses with the least dramatic products and the most boring durability. Markets love to underprice boring durability during fear cycles because boring durability does not generate thrilling headlines. But boring durability is exactly what lets a company survive a valuation winter and emerge stronger when the weather changes. I have made a great deal of money in my life by understanding that glamour attracts the crowd while durability pays the owner. That is why the software rebound matters to me. It is not just a trade in sentiment. It is a test of whether the market is ready to remember a basic truth. Technology revolutions do not always destroy the existing landlords. Many times they make the best landlords richer. Think about what has actually changed since the prior run. Up demand for AI infrastructure has not evaporated. In many areas it has intensified. Enterprise appetite to use automation, co-pilots, data tools, agent systems, and productivity enhancement has not faded. It has broadened corporate urgency to squeeze more output from the same labor base has not weakened. It has become a board level requirement. The build-out costs are real. Yes. The uncertainty is real. Yes. But the addressable prize is larger, not smaller. That matters because price has memory, but earnings eventually have gravity. If the market marks software down for months on a fear that now looks exaggerated, and if the actual earnings season begins to show that spending, usage, client expansion, backlog, and monetization are still moving in the right direction, then you have the classic ingredients of a multi-quarter re-rating. Not because every company becomes a winner, because the market will have to admit it punished the entire group too aggressively. That is where V-shaped comments can be misleading. People love asking whether they missed the bottom, whether the rebound happened too fast, whether the easy money is gone. Usually those questions come from a hidden desire not to invest, but to be reassured. I do not invest that way. I do not need the exact bottom. I need a favorable gap between price and future business value. If that gap remains large, then the first move is not the end. It is the beginning of a process. That process can take months, it can take quarters, it can wobble, it can scare people twice before it rewards them once. But when valuations are deeply depressed and fundamentals are merely stabilizing rather than collapsing, the upside can still be substantial long after the headline bottom. This is where temperament separates owners from tourists. Tourists want a stock that goes down, then receives a public certificate of safety, then goes back to the old high without making them uncomfortable. Owners understand that repricings happen through tension. They understand that the market often gives you the bargain first and the comfort later. If you insist on having both at the same moment, you will spend most of your life buying quality at ordinary prices instead of buying dislocation at advantage prices. Now let me give you the blueprint I would use if I were building exposure here carefully. First, I would separate software into 3 buckets. The first bucket is proven scale with installed base power. These are the businesses that sit inside customer workflows so deeply that AI is more likely to expand their economic value than erase it. Oracle and Salesforce are examples of the kind of names that belong in this group. The second bucket is transition businesses. These are firms with real products and real customers, but where the market still needs proof that growth margins or monetization will tighten meaningfully. They can work, but the evidence burden is higher. The third bucket is speculative optionality. These are names where upside can be spectacular, but the business still needs to earn the right to be treated as durable. SoundHound belongs closer to this category. Second, I would size the buckets according to certainty, not excitement. That is where many portfolios go wrong. Investors hear the loudest upside number and allocate the most capital to the weakest certainty. Then when volatility arrives, they call the market irrational. The market simply reminded them that risk and reward are cousins, not twins. Third, I would demand a different catalyst for each bucket. For the first bucket, I need proof that fear is fading and earnings power remains intact. For the second bucket, I need evidence that the transition is improving on schedule. For the third bucket, I need a line of sight to profitability sharp enough that I can believe the future without writing fiction for management. Fourth, I would keep my eye on valuation discipline. This is where mature investors earn their money. A great business at a stupid price can still be a stupid investment. But when a strong business with adaptation power, embedded customers, and shareholder-friendly capital allocation gets pushed down to a multiple that assumes structural damage which has not actually occurred, that is not merely a lower price. That is a transfer of opportunity from the frightened to the patient. Fifth, I would remember that market rebounds are social before they are mathematical. The early stage of a rebound is not just about fundamentals. It is about permission. One group buys, another group notices, analysts stop, sounding apocalyptic. Targets stabilize, commentators discover nuance they did not possess a month earlier. Then retail money returns, then momentum funds arrive, then price itself becomes part of the story. If you understand that sequence, you stop being surprised by how far beaten down leaders can run once sentiment flips. That is what I believe may be beginning in software. Not a straight line, not a guarantee, not a mindless return to every prior high, but a recognition that the market spent too long treating adaptation as impossible, treating AI as a one-directional weapon, and treating software leaders like helpless bystanders in their own future. I do not see helpless bystanders. I see managers investing in infrastructure because demand is there. I see franchises with deep client entrenchment. I see cash-rich operators shrinking share count while the market doubts them. I see a physical bottleneck around AI build-out that gives incumbents more time than the fear narrative admits. I see a sector where investors were paid to be pessimistic long after pessimism stopped being intelligent. That is why I think this rebound can become much larger than people expect. Because the market is not merely climbing from oversold conditions. It is correcting a conceptual mistake. It misunderstood who is likely to benefit from the next phase of AI. It assumed the software layer would be first in line for extinction, when in many cases the software layer may be first in line for monetization. That is a different future, and different futures command different prices. Let me say one more thing. Because this is where investors often betray themselves. They treat uncertainty as a verdict. They say, we do not know exactly how AI will reshape software. Therefore, the safe course is to avoid the sector. But the market never pays you for waiting until the shape of the future becomes obvious. It pays you for correctly distinguishing between uncertainty and impairment. Impairment means the business is weakening in a durable way. Uncertainty means people are afraid to value what they cannot yet model neatly. Those are not the same. If you can keep them separate, you will make better decisions than most of the market. And right now, I believe software is offering exactly that test. The old fear story said these companies were about to be made obsolete. The newer evidence says many of them are repositioning to become more essential. The old price action said the market wanted nothing to do with them. The new tape says buyers have started to move. The old valuation assumed a damaged future. The current setup suggests a richer one. That does not mean recklessness is justified. It means attention is justified. If I were sitting with a young investor today, I would tell them this: do not waste a sell-off by learning the wrong lesson. The lesson is not that software is dangerous. The lesson is that panic can make even strong sectors tradable at foolish prices. The lesson is that installed bases matter. The lesson is that customer entrenchment matters. The lesson is that buybacks at depressed valuations matter. The lesson is that infrastructure bottlenecks can buy incumbents time. The lesson is that speculation must be sized differently from quality. The lesson is that markets punish nuance in the short run and then reward it in the long run. That is how fortunes are made. Not by guessing every daily move, not by worshiping every new technology, not by hiding from all uncertainty, by recognizing when fear becomes lazy, when price outruns damage, and when the best positioned businesses in a frightened sector are being offered back to you at a discount. Software is starting to look like that to me. The last time markets did this to a major technology wave, early owners who understood the difference between temporary fear and lasting value made an extraordinary amount of money. The opportunity was not in buying the loudest story, it was in buying the strongest businesses after the market had lost its nerve. That is still the game, and if you understand it before the rebound feels comfortable, you are already ahead of most people who will eventually pretend they saw it coming all along.